Now imagine for a moment that you had to liquidate your entire dividend portfolio to pay for an unexpected expense and avoid taking on high interest debt and bringing your your projected annual dividend income, that is, to zero. I thought about this too, and if I had to start from zero right now today, what dividend companies would I buy to go from $0 to $100 in annual dividends? To begin the process of converting cash into wealth producing assets, I would want solid companies that grow their dividend each year, they're at a decent valuation, and they are at very low risk of cutting their dividend. And as always, remember that dividends are not a guarantee. They can go away at any time. But many companies take their dividend very seriously and look at a cut as a measure of last resort. And with all that being said, I would start with the monthly dividend company Realty Income, ticker O. Realty Income is a real estate investment trust, or REIT. Now that allows you to become an instant retail and industrial landlord that, like their name says, pays a monthly dividend. Realty Income founders William and Joan Clark acquired their first property in 1970, a single Taco Bell, and has now grown to over 11,200 properties in the United States and Europe, with top tenants like Walgreens, 7-Eleven, Dollar General, and FedEx. Now, Realty Income has beautiful and incredibly detailed investor presentations on their website that I highly recommend checking out. And with 27 years of increasing dividends, 98 consecutive quarterly dividend increases, a Simply Safe dividend safety score of 70, and a current yield over 4.5%, this dividend aristocrat, in my opinion, is a must-have. I'm adding 5 shares of Realty Income, and at $2.97 of annual dividend income per share, that gives us $14.85 of Patty. Johnson & Johnson is next on my list, and they are a favorite of the dividend growth investing community, and with very good reason. J&J first paid a dividend in 1944 and has increased it every year since 1963, and has had one of the most steady dividend increases around. Now, do be aware that pharmaceutical and medical technology accounted for almost 80% of sales in 2021. And in 2023, Johnson & Johnson will be spinning off their consumer health segment into its own publicly traded company, but J&J expects to remain the world's largest healthcare company. Now, some investors are concerned about Johnson & Johnson's drug pipeline going forward, but they currently have 94 pharmaceuticals in development and see the potential for 14 new multi-billion-dollar drugs by 2025. Johnson & Johnson receives a dividend safety score of 99, is one of the most well-run companies in the market, and should be able to keep increasing their dividend for years to come. I'm adding 3 shares of Johnson & Johnson. That gives us $4.52 of annual dividend income per share, good for $13.56 of Patty. Quick, stop the video, run to your kitchen, laundry room, or bathroom, and see how many Procter Gamble, ticker PG, products that you have. Oh, hey, you're back. I'm guessing you have 5 products at least from Procter & Gamble. Let me know in the comments below if I was right on that number. Founded in 1837 with products in over 180 countries, Procter & Gamble has lately been focusing on their main brands to dominate product categories and drive the company forward through all economic environments. Most of the company's over $20+ billion brands are number 1 or number 2 positions in their categories. Procter & Gamble has been paying dividends every year since 1890 and an increasing dividend for the last 65 years, and they are a dividend king. Their dividend has an 8% 20-year CAGR, a Simply Safe dividend safety score of 99, and I think they're targeting 100 years of dividend growth at this point. I'm adding 5 shares of Procter & Gamble, and at $3.65 of annual dividend income, that gives us $18.25 of Patty. Hey, did you see what J-Pow was carrying at the last Fed meeting? Yep, It was a Texas Instruments TI-84 calculator, which is the next company I'll be adding to that dividend portfolio foundation because everything is going digital and Texas Instruments is helping to lead the way. But check it out, only 24% of their revenue is from personal electronics. Every electronic product requires analog technology because analog provides the power to run devices and is fundamental to how human beings interact with technology. And luckily, Texas Instruments is the world's leading supplier of analog devices, which accounted for 77% of their 2021 revenue. Texas Instruments has been around since 1930. They have a Simply Safe dividend safety score of 90. They have paid an uninterrupted dividend since 1962 and have been increasing that dividend for the last 18 years straight, on top of a very nice 20-year, 22% CAGR. I'm adding 4 shares of Texas Instruments, and at $4.60 of dividend income, that gives us $18.40 of patty. Now, when we shop, our bodies release the feel-good hormone dopamine. And because of this, research has found that if people are feeling sad, shopping will make them happier. So the more we shop, the better we feel, and I'm feeling pretty good adding Target to the portfolio. Target recently suffered their biggest single-day loss since Black Monday of 1987 due to the sudden shift in consumer spending on experiences instead of stuff, which has led to an inventory buildup on top of a spike in transportation, freight costs, and supply chain issues. And I think all of these are short-term problems that in a decade and more will look like a blip in the company's history and currently present us with a fantastic buying opportunity of such a well-run and managed company. Target has a Simply Safe dividend score of 90, and they have been paying an increasing dividend for 50 straight years, making them another dividend king. They're sporting a double-digit 20-year compound annual growth rate of 14%, and I think they should have few issues paying and growing their dividend for years to come. I'm adding 4 shares of Target, and at $4.32 of annual dividend income, that gives us a patty of $17.28. Now, when most people think of Pepsi and their parent PepsiCo, they think of soda. Well, think again. 55% of 2021 net revenue came from foods, and their second leading driver of sales was from Frito-Lay North America. And during the pandemic, they started direct-to-consumer websites Snacks.com and PantryShop.com. Pepsi Soda was created in 1898 and incorporated as Pepsi Cola in 1902 and merged with Frito-Lay in 1965, and today is a worldwide giant, bringing in almost $80 billion in annual revenue. Now, some worry that the shift to healthier foods could affect PepsiCo, but in the words of the late great John Panette,
I say nay, nay, it's easier for me.
PepsiCo's broad portfolio includes an expanded range of products that are better for people, better for our planet, and we are continuing to build our portfolio of products featuring easy to understand nutritional labeling, reduced added sugars, sodium, and saturated fat. And come on, how do you not love this girl in the Chicago shirt eating her Quaker oats? In early 2022, PepsiCo paid their 50th consecutive dividend, making them a dividend king. They have an 11% 5-year CAGR and a dividend safety score of 93. I'm adding 4 shares of PepsiCo, and at $4.60 in annual dividends, that gives us a patty of $18.40. So to recap all that buying, that's 5 shares of Realty Income, 3 shares of Johnson & Johnson, 5 shares of Procter Gamble, 4 shares of Texas Instruments, 4 shares of Target, and 4 shares of PepsiCo, which gives us $100.74 of annual dividend income at just over a current market value of $3,300. Now, I'm so confident in PepsiCo, I bought 1 share a week for 100 weeks, and you can find out everything I learned about that in this little box next to my head, and I will see you there.